Hey team, can I get a couple ones in the chat? If you guys could see our screen and hear Luis and myself perfectly fine, and you can see Luis's screen, those handsome pictures there, they were all photoshopped. That guy, man, we spent so much money on photoshopping. Perfect, we got some ones. All right, thanks everybody for joining us.
Stories in the house. Chuck J, awesome. All right,
yeah,
so let's
look at this. I love it. Thanks everybody for joining us. We want to wish you a very happy Friday on this season 2, episode 5. How amazing is that? My name is Hector Hernandez. I am a real estate wealth building coach here at Real Life Trading, as well as a real estate fund manager. And joining me today, as always, is my buddy, my pal, my co-host, my business partner, and the superstar of all time, Mr. Luis Alejandro Lopez.
Yes, sir. So, hi, everyone. My name is Luis Alejandro Lopez. I'm a real estate investor, expert in flipping homes, and I'm also a coaching here in Real Life Trading. So, we have a nice show for you today. If you've been hearing us for the past couple of months, we've been doing research in properties where we can pick up, rehab, and resell. So, today we're going to do something slightly different. I was looking into some videos and I came across a video from Bigger Pocket. Oh, before let's, you're right, bro. You're right. Let's disclaimer. Okay, I think I know what I'm doing. Hector thinks he knows what he's doing. At the end, if you're gonna buy a house, make sure you know the values. Make sure you know your numbers. You check them. Ask questions. That's what we're here for. At the end, if you sign the dotted line, you're responsible for the house. You're responsible for the loan. You're responsible for your mistakes. So please make sure that you think you know what you're doing. And if you don't, please ask questions. That's what we're here for. Okay. So let me go back.
Actually, before you go too far, team, I know that we all got a lot of stuff to do and it's Friday, but I want to encourage everybody to stay till the end, because not only is Luis about to drop some knowledge bombs when it comes to the rental market, but if you've been wondering where to get deals and capital to fund those deals all in the same place, we got a very special guest for you on the second half of the show. So make sure you stick around. My buddy Jeff is going to come on and he's going to just drop some knowledge bombs on you guys and share with his business model, what his company does. And it's going to be very, very valuable. So make sure you stick around. And what's up, Darian? Go for it, Luis.
Go for it. Okay, good. All right. So we're going to talk about rentals today. All right. We've been looking for properties that we need to buy and fix and flip and resell, etc. So let's change the things a little bit. Let's look for properties that we can buy and we can rent for cash flow. Remember, when we say cash flow is king, we want to have money coming into our pocket every month. We can use that cash flow to buy even more cash producing assets. So I'm going to talk about what is called the rent to price ratio. The rent to price ratio basically is your ratio is simple, where you take the monthly rent and you divide it by the property value. Okay, which is what we're going to be seeing in a little bit later. That's the video that Bigger Pocket paused, that we're going to be looking into several markets. So what you need to do is, give me a second.
I heard it was also called the make money formula. I don't know. Maybe I'm just making that up.
Yeah, that's the whole plan. So the idea is that the monthly rent, okay, divided by the property value. My property value mean everything that you spend. So if you need to buy it and fix it and rehab it and do things, you need to put the value of all the money that is going to incur on your cost. So it's the purchase price plus your closing costs plus whatever repair that you're going to do. The monthly rent divided by the property value has to be equal or more than 1. So in a simple matter, if you have a property that is $150,000, okay, and you rent it for $1,500, you're gonna get a ratio of 1. Simple, easy. Now, if you get a property like in the example that is worth $150,000, but you rent for $1,800 a month, then your ratio start increasing. So it's an easy way to figure out if a property is a good cash flowing property. Now, it's not a strict rule, because we're going to see, depending on where you at, you're going to have different property values. Depending on the property, you're going to might have extra expenses, homeowners associations, things like that they're not really included here. But as a regular rule of thumb, these values work. which is whenever brings me to the next thing. I'm not sure if you heard about the 1% rule. It's the same thing said backwards. Okay. This is the rule of thumb for positive cash flow. The monthly rent needs to be 1% of the total investment. So you see in a house, the house is 200 grand and it rents for 1,500, you don't meet the qualification. But in the example here, $100,000 home needs to rent for at least 1,500. What does that give you? That gives you a parameter to things that just don't work and the numbers don't make sense. Just dump it, put them on the side, and don't spend time with them. Okay. So ideally, you want to find a home that, for example, is if 150,000, you can rent for 1,750, 1,800, 1,900, et cetera, et cetera, et cetera. Now, the situation has become slightly difficult ever since, the big depression or whatever, the big crisis we have in 2008, 2009. At that moment, the prices of the rents did not go down with the values of the properties. However, we have a huge run that we talked about ever since 2010 up to now, basically May of last year, where the property prices increase and the rent values are trying to catch up. Now, in some areas, the rent values are also increasing exponentially. I got friends in South Florida that are going nuts because rents are going year to year, 700, 800 months difference. However, they're still not catching up with the big boom that we had on the increase of the prices. So, according to BiggerPockets, and let me give you guys the source so you can watch the video. I'm going to put it on the chat pane. I need to watch it right now. But these are the markets that have the top cash flows in the country. Okay, Rochester, New York. I just posted the link in the chat whenever you guys feel like watching it. It's the director of data from BiggerPockets. That's what they do. They analyze markets and they just go and bundle on them.
And he's
Rochester,
good. I love watching his data videos because the guy just focuses on data. It's not what he thinks, what he feels, how he woke up that money. It's all about numbers, and he's very good at breaking it down. So highly suggest you guys check out some of his videos.
So according to him, these are the markets, the top markets right now for cash flow: Rochester, New York, Little Rock, Arkansas, Milwaukee, Wisconsin, Dayton, Ohio, Philadelphia, Pennsylvania, which is the only big city in the list.
Then DJ made the market list.
DJ made the market list. That's right. Now, Birmingham, Alabama. This is the one I want to have a look at. This one is literally an hour and a half away from me. So if this one works, you know where the next videos will be coming from. Cleveland, Ohio. Now, Memphis, Tennessee. You might, the big peeps here, the Nashville crew. I'm not sure how far away is Nashville from Memphis, probably like 3 hours, 4 hours. It might be something that is worth looking at. Okay, if you want to buy properties that cash flow kind of immediately, go for it. And Baltimore, Maryland, my boy Alonso. Where's my boy Alonso? He's probably not here today. He's looking at properties in Washington, D.C., Baltimore, and in Maryland. So I need to send that to him or send him the recording. This, according to him, Kevin, okay. Is Kevin here?
Oh, Kevin is in Alabama. That's why, Kevin, if you're here, you need to be listening to what Lewis is about to drop. I will say this, Lou, remember that event that I was at the weekend before last? Learned so much about that West Tennessee area, Memphis. There's a little bit actually northeast of Memphis. There is a new Ford plant coming online. FedEx is expanding. And there's one more job creator that I can't remember off the top of my head, but essentially there's like just a silly amount of jobs being created as we speak right now in between Memphis and the north corridor, just heading northwest of Memphis, about an hour north, which is just perfect, right? So these are the things that we always drive at, team, is job growth equals population growth equals rent growth equals profits in your pocket.
Mm-hmm. So let's look into one. The one that we're going to look at is Birmingham, Alabama. So let's do and use our tools that we always use. Again, I'm not going to go crazy. I don't have MLS in Alabama, but let's make sure that, the numbers are correct. And again, guys, this is what we do all the time. Okay, this is when we look into a market. Okay, let's dig in. Let's figure out what is around, what's here, what's there. All right. So we are in Birmingham. Anybody in the chat right now that is familiar with the area? Because I'm not that familiar. We're gonna start looking kind of randomly. But if anybody is familiar with the area, I will really appreciate that. We're gonna be looking for properties from 50,000. Let me put it a little bit higher. Let's put 85. 85,000 to 250, 300s. Okay. We're going to be looking for properties that we prefer to have 3 bedrooms and 2 bathrooms, ideally. Okay. Because that gives them a family the room to grow. And I don't like to look at, I'm not looking to multifamilies. I'm not looking to condos, apartments, lots, manufactured. Probably not now. Let's look into houses and townhomes. Okay, so we have, according to this, we have 173 results. So let's do sort by newest. So whatever was just posted. So let's look for stuff that has been on the market for a while. And let's see if the numbers make sense. Why I'm looking for properties that have been in the market for a while? Because these people might be willing to negotiating a price. Actually, I saw this one last night. This is a portfolio.
268 days. Dude, that's almost a full year. So what do you think the seller's thinking right now, Luis?
They want to sell it. However, this is a portfolio, if I'm not mistaken. This one is a portfolio that I can lead on. So let's have a look at this. How many days in the market?
It was right? 200 and something. I just lost it. You had it there. 268, if I'm not mistaken.
The market. Okay. So let's have a look. We're going to use another tool that we have up here, Sprintometer. This is one of the tools that, again, is as good as the data that's been dragged from with the spiders. They pick up information from the MLS, from all kinds of places where they pick up the data of how the properties are rented, and then based on the address, it's going to give you a range, high rent, low rent, and it's going to give you a median. Okay, it's fairly accurate. Again, you will probably have to dig here and there and everywhere a little bit more, but for a quick search and see, okay, it makes sense, let's do it. And then we look into, if it's really looking, then we call an agent and we verify all those numbers. Remember, we're not agents in the area. We're looking by the data from Zillow, which is not usually, it's current, but there's estimates and there's things that are not the best. All right, so we're looking at Robert Drive, Birmingham, Alabama. Let's look half a mile away.
Before you go too deep, let me just give a little bit of so Rentometer is like Luis said, a rental tool. So right now he's using a pro account that we pay, but they do give you a trial and you're able to run several addresses and look at, I think it's like 5 or 10, I don't really remember. It's 5, okay. And then I mean, I think I got it on sale over Christmas for like a year. I think I paid, I don't know, $50, $45. So it's really affordable. It's not expensive. If you want a quick, fast way of just throwing in an address and getting an idea of what the rental rate is in that area, if you're considering buying rentals at all, long-term rentals. This does not touch short-term rentals, Airbnbs, none of that good stuff. This is going to be those long-term rentals. This does help out. I have yet to find a neighborhood that I stump it, but then again, I play in larger metropolitan areas. So if you're in a real small town, it might have an issue. And actually, I just remembered there is one small town here in Florida that I play in, Northwest Florida, that it did not have a lot of comps, but that's one of many markets.
Okay. So another
what
one.
were you showing us there?
Yeah, the other tool that it can be used is Smashvisor. We're using this one for, it gives you information for short-term and long-term rentals. Okay, so it gives you both. If you put the same address, I don't have this one right now. My wife is the one that has the password, and I forgot to ask her before okay, let him do his thing. I'll let it do here his thing. Let's do.
So this does short-term rentals as well, Lou?
Yes, sir.
Smashvisor?
Yep, Smashvisor. It's similar to AirDNA. We picks up the information from Airbnb and,
Okay.
gives it back depending on your zip code and the quality, whatever. So it's similar. Once you do analytics, if you Airbnb or traditional, I don't have the username and password with me, so we could have seen it. But I want to use Ringtomer pretty much, I think it's better. Okay, this one is very, very focused into the Airbnb thing.
Gotcha. Okay.
So this is
there he is, my man Kevin. Welcome to the party, buddy. You're not late. The party starts when you get here.
So we're talking about 3 bedrooms, 1 or more. Let's look at the last 12 months of rents, okay, in half a mile radius. Let's see what it tells me. And we're looking for houses. All right, so we're looking again at a house that, let me just move this one out of the way. We're looking at a house asking 139, but again, it's been in the market for almost a year. And it's a property that is renting for average 1142. The median is 1180. The highest rent in the neighborhood is 1261. So just by looking at the numbers, this one won't work. But how can we make this one work? By throwing a what to the seller?
Offer less money.
Offer. Okay.
Clearly, he's not getting his asking price in 268 days.
Sure, it's not getting an asking price being a year there, but just by running the numbers, you need to be the full properly rehabbed and done. And again, we don't have photos interior, so we don't really know what's going on here. It's currently rented at $1,300 a month, which according to this is good. Okay, it's the highest percentile. So maybe just go throw him a low ball offer. Throw him what, a 90, so you can settle in 100.
I like that.
I like that, and see what happens. Okay, so for now, this one kind of coulda work. Let's have a look here.
And then so I'll add a little bit to that, Lou, because we often talk about days on market team here quite a bit. And so as we've said in the past, somewhere between 90 and maybe 120 days is when sellers start to think about what's going on here. Realtor starts to let them know, hey, your listing's going stale. 90 days is it's about a good even market. It's not a seller's market, it's not a buyer's market. Now, once you get past 120, that's 6 months. It does start to take an emotional toll both on the seller and on that realtor. Most realtors do 12-month contracts. So the closer it gets to that 12-month, the more pressure that realtor is applying on that seller, and the more they are using their sales skills to help you get your deal because they want to get it done so that it doesn't become an expired listing. If it goes to an expired listing status, that's when wholesalers and investors like Lewis and I, like my buddy Henry, we start knocking on their door. Hey, we saw your realtor couldn't get the job done. How about we give you 90 grand now? And you save that commission. It happens every single day. There's not only do realtors themselves go after expired listings to market for clients, but also investors are heavily focused on it. So trust me when I tell you that these realtors are starting to get creative in the way that they're presenting your offer much more after day 120 than at day 30.
If I never, you did the pro report here? No.
So the report, we have a limited amount. So this is about fine for what we're doing. I think if you want to do the other one, you could do this right here. What I do is I'll go back real quick. And then it gives you like change this to the first option.
And this is North Alabama. All right, so let's look at this one. This property has been on the market again for 245 days. Okay, more than 6 months. Completely remodeled, completely painted, new windows. This seems to have a new roof. Everything's super nice, clean, and pretty. So this is move-in ready. Great. Completely remodeled according to the Cassandra Chandler, the realtor. I was trying to see the history of this one. It says this estimate is 164. We've always thought that these estimates are a little bit inflated, okay, which is, what Sila does. They want to, they want to tell you that the value of the house is really high, so you can go and call them or call a realtor. Remember, this is a promotional website. They sell the ads for realtors that you want to talk to, okay? If you want to contact an agent, they have, here, this button is it's for sale, basically.
It's where they make money, yeah. And what's funny is like they're listed above the Zillow pricing, and I already don't love the Zillow pricing most of the time.
Yeah, they bought this house for 10 grand. I don't know why. I don't know how. Maybe it's a complete remodel. Let's see.
It does happen in some areas of Birmingham.
All right, so let's have a look. This property was in April 2021. This is the condition of the
That's
property.
tarp?
No,
Yeah.
it's not a tarp.
Oh,
Sorry.
it's just something funky is going on with the roof for sure. So yeah, it looks like that they did a roof, yeah.
They did a roof immediately. You see how this thing is sagging to the side and sagging over here. So yeah, they had to do the whole thing, most likely. Okay. Okay, let's have a look at the neighborhood. The house is basically the same as all the neighbors. Looks clean, looks decent, doesn't look doesn't look bad. Except for the broken BMW, that's a classic.
Hmm.
All right. Yeah, I know I had one. Okay, they sold it in 2021 for 10 grand. Who knows how they bought this? And they put it for sale a year later for 170. They have not reduced the price since July. Okay, won't be surprised that this property, the way it is right now, it might be set up for an Airbnb. Okay, because it looks very, very clean. So let's have a look at what the retainer says. Okay, we're talking again. This
change that the option there on the 3 bedrooms, and it'll give you that one, yeah, summary, and then it'll give you a slightly different report with different sizes.
Okay.
There you go.
3 bedrooms in.
Go ahead.
3 bedrooms in the neighborhood. The average is 1173, which is really low. 75%.
Well, it's really low for what they're asking, but it's great for what they paid. They paid 10 grand. I mean, even if they put 80 grand into it.
They probably put more than 80. New windows, new fascia, new roof, new kitchen, new flooring, new bathrooms. I'm sure the AC is probably new as well.
Yeah. Yeah, they probably had some frames to repair and all kind of good stuff there.
Let me see if I can find more information here. And now, guys, if you're here and you have questions, that's what we're here for. Okay.
I got an address when you're done with these. Just posted it in the chat for you. Whenever you're finished with these, we'll check one of those out.
Property history, here it is. No, they don't have no recording. Who the hell knows how they bought that thing? Nearby home values. Let's see. 170. Yeah. So probably remodel. That's what they were going for, and with no repairs or no nothing. That's what they're going for. So you got a nice margin there.
Great margin for sure. Yeah.
Yep. All right. Let's see what this is. Tell me anything else. Open houses, 3 bedrooms, 2 bathrooms. So again, looking at the numbers don't make too much sense. However, brand new home. Let me close this one. Brand new home probably is going to bring a little bit more extra money, but it's not going to bring, the difference from 13 to 17.
Yep.
Okay. Now, if it was a 4 bedroom, maybe, but yeah. Let's have a look. Where is this address?
I just put it in the chat for you.
Where is that?
And then, so while Lewis is looking that up, team, I will add that the 1% rule works great on things particularly under 300 grand, it does start to get a little difficult to do over 300. And that's just, you know, an arbitrary number. It could be 400, 300, but it's just the higher you go, the harder it is to hit that 1%. Not saying it's not doable. I'm just saying you're going to have to search a little bit harder for those. And then that's just a very basic rule. Like I've always said, I prefer risk adjusted returns. So the riskier the property, the way higher I'm going to want to be than that 1%. The less risky, the more willing I am to do 0.8, 0.9, you know?
All right, so we're looking at this property, 105. Property is gutted, has no kitchen, has no walls, has no bedrooms, has nothing, no flooring, no nothing.
Kevin, was this you? Did you gut this house? Were you that upset, man? Did you take a sledgehammer to it?
Was this one? Yeah.
Bad week, huh? When the markets don't go your way, you just take a sledgehammer. Nah, we're kidding. We're kidding. He's looking at it. It just came up in one of the markets that he looks at.
Okay. So let's.
I don't know how long this one's been listed for, Lou. What? How many days on the market? Can you see that?
Not yet, but let's see if I can find it here and see if it tells me. No, from here, 72. Right. Let me go back to see. 14 days on Zillow.
Perfect. So this one's pretty new, but they're clearly in need of some help because the property looks rough.
Yeah.
It looks like they started the rehab and they potentially got in over their heads, or they ran out of cash, or life circumstances. Happens all the time. Everywhere we see it regularly.
Because I went driving up to Rome and Cartersville, some towns that are around me, and all the houses that I saw were like this. People started doing the rehab, and all of a sudden they just stop and try to sell. And of course, they're trying to sell it like, you know, you only need a little coat of paint, and then you go there and, you know, need to do walls, need to do everything.
Yep.
Let's see, property details. The possibilities are endless, for sure. They are. Initial plans for a 3-bedroom home with new floor, new trusses, tucked away, Piney Point, motivated to sell, bring an offer. Okay, that's a good sign. That's a good sign. Maybe you can snatch this for, you know, 75, 80.
What can you see what it got it for? See if it shows on the bottom. There it is. 72.
For 72, and they're listing it for 105. And look, they in 19, somebody picked it up for 75, and then I guess they couldn't do anything, and then, you know, let me recoup my money. I'm not really sure. Wait a second. There was.
I doubt that. If they held on it from 19 to 22, they did not recoup their money. They lost money on taxes, commissions, etc., etc. They didn't lose a lot of money though. They definitely covered some losses, but oof, that's brutal. So that's definitely a little bit of a concern, right? When it's been two or three different people that have attempted, and for some reason the project has failed. It says that they have plans. It might be a city issue. It might be a building department issue. It might be a lot of stuff. So usually I'm not afraid to pick up a project secondhand from an investor that's struggling, that made a mistake, or even a homeowner that got in over his head. But usually on those, we're going to look at them with an extra magnifying glass, because the city's already involved, the buildings department's already involved. So they're going to look at you with a magnifying glass. And so things could take a lot longer than if you open a fresh permit and you start construction brand new. This one probably has already upset a couple of inspectors or somebody at the building department. And so they're going to come in and look at every tiny little detail. So you better have a wide margin to deal with any surprises that scare these people off, and to deal with the building department.
You have a newer metal roof, which is a big plus. You see, 2008.
I see that, yeah.
You got the new roof. That, I'm not sure why they had to, you know, turn out everything, because that should have been kind of leak proof. And then whatever happened next is the property warranty.
The exterior looks nice in 2014. Way nicer than it does 2022.
Life happened to it.
Yeah.
It's no big, you know.
Kevin, do you have any sort of backstory at all on this, or is it just kind of new on your radar? No backstory. Okay. So that's probably where I would start when I start to look at something like this. Again, we're either going to go for large margin, which at that point it is what it is. We'll take whatever challenges comes. Or I'm going to be digging around. I'm going to be asking the neighbors what happened with the last couple owners. I'm going to be asking the building department, you know, seeing if there's any open permits, any open violations, talking to those inspectors, talking to those city officials, and just on information gathering mode at that point.
This one next door was messed up and now it's fixed somewhat.
Sometimes there's a reasonable story, and sometimes it's a money pit and you need to stay away.
Yeah. The other thing I was gonna say, just for the sake of looking at it, the neighborhood looked way better in 2014. You see houses around them look cleaner, all of them. And I know this picture was taken, you know, in spring, summer, everything looks green and nice, but still, you know, if you come to think of it, they're okay. They're, especially this one looked nice, way nicer in 14. Well, okay, it's just a matter of just looking into what was there. You have now a warehouse, so they did a big thing there. Who knows? Big garage. Values for this one. Let me see. Let me see the rent too. And again, guys, if you have any questions or want me to look at something, that's where we're here. Three, two, 3, 2, same thing. Okay, let's just analyze this one. All right, we're talking. We're talking. Why this goes so high, I'm not sure. So let's make back to the 3 bedrooms and 2 bathrooms. All right, you have opportunity there. I like it.
I like those numbers right
I
there.
like it. The average is 16,000, so 75%. If you make the house really, really, really nice, even if the house is a piece of junk, you're still, right now, the question is that you need to pick it up for way less. You need to be all in this thing at 130. And by looking at these pictures, you probably need some good 40, 45 of repairs. My usual prices. So you see, you have no finishes, you have no flooring.
Maybe a little more because of the building department being involved, but yeah, I'm somewhere between 50 and 65-ish. Your microphone is on.
You can define so you know which go to maximize or what we find the science is much about the balance you have to use that money to go look at. Remember when we have right the version exactly what you have. So again, the high, I'm sure you can do this. Not a problem.
Your microphone is acting a little funky. Your voice is all garbly. Sounds like you're under the fish tank, doing a fish tank. Under the sea. Sorry. All these songs are stuck in my head. I know you know about some of those, Emily. Ron, while Lewis gets his microphone going, thank you, Ron. That means a lot to us. He says he does not have a question, but he does appreciate the information and he appreciates the show. So thank you, Ron. We appreciate you being here. Lou, I don't know if you want to shut down maybe some of your background apps, kill your Outlook if you got it open, or anything else that you got open. I wouldn't replug in the microphone though. Don't do that one. Stick to the PC microphone, man. Don't do that. That's the computer killer microphone.
Let me
That's good. I think you're sounding good. Keep talking.
hear me. You hear me? Can you hear me?
Perfect.
All right, good. So I guess I need to plug the bad microphone in. So I guess it's okay with the drivers. I need to call Dell. I'll get a Mac at the end. All right, so
Oh, come on, man. Don't do that.
I'm
Apple is for buying stock, all right?
trying to avoid it. All right, so let's keep looking at somebody else.
I'm looking forward to meeting you as well pretty soon, Justin. Can't wait. Hopefully
Let's-
Orlando will be the time. Hey team, are you all
Yes.
going to Orlando? Did you all know that Real Life Trading is going to Orlando? I don't have the
Yeah.
exact dates right now in front of me, but we'll look that up here shortly. It was sometime in May. There you go. Emily says May 21st through the 24th because Emily's always ready. You see,
Yes.
team, if you stay ready, you don't have to get ready. That's why she's always ready.
Let me see. Do you have the link for Orlando, Tampa meetups? There it is.
There it is, Margaritaville. And yes, they do have awesome margaritas.
Yes, Emily, you're
Oh,
in
yeah.
some panelists. But yeah, 21 to 24. Here's the information. In Margaritaville is gonna be a full day trading, everything day trading. So you say swing, you're gonna get smacked in the head.
All day trading. Woo, that's gonna be fun.
All right, I don't have more details here. I'm sure Emily, Sochi, Jeremy, the whole crew is working on a good.
May 21st through the 24th. See you all in Orlando. All right,
Yes.
sorry about that, Luke. Got a little
We'll be-
sidetrack there. Let's get back to where you were going.
The regular schedule.
Back to a regular scheduled programming. So yeah, Kevin, long story short, dig in. Let's look at we looked at the rental value. So that's definitely they look good. They're definitely on the up and up. You might have to get a little closer to it. He actually paid for it somewhere around 70 once you do your budget. But I would just look very closely at why they have failed to complete the project. And if there isn't a really good, compelling story, chances are it's more of a property related story. So you might want to steer clear of it.
Yes, or you might want to spend the $300, $400 and bring a good inspector. I'm sure a real estate agent close to you can point you into those inspectors that they call them the deal killers. Because they point every little thing. That's what you need. Not to kill the deal, but to help you negotiate furthermore, okay? I've done that. Hector's done that. It's,
Do it all the
Alright.
time. Just killed the deal not that long ago, right? Or that was actually a GC that helped us kill that deal. And hey, you know what?
Yeah.
It was the best $1,000 I ever lost.
that's right.
It was that's our stop, right? Hey, we had a deposit in, we knew it was a non-refundable deposit, we did our homework, we brought the GCs in. The budget was exponentially larger than what we had anticipated and what we budgeted for when the GCs dug in, and we pulled the plug.
Mhm.
Walked away from the deposit. It was, $1,000 deposit on a potential $400,000 property. So, that's I don't know, 0.25%. Definitely a good risk reward.
All right, let's have a look. 135. This looks way too pretty for 135. And I have no information.
Well, we're on the right side of Zillow. Zillow says it's worth more.
Looks way
If that
too-
means anything to you.
Yeah, so remember, in Florida, the only thing indoors you can buy with 135 is a Model X Tesla. That's it.
Yeah, there's a couple of there's a couple condos coming up now, 1 bedrooms.
55 and overs.
Yes, exactly. In the retirement community.
Yeah, soon I'll qualify, but not yet. 4 bedrooms, family room, kitchen, dining area. We don't have no idea. Lovely then has a fused yard. They listed started at 159. No, they started, Jesus, They bought it in 2019, right before COVID for 117. They listed in May at 159, and nobody's buying in that neighborhood. Okay, 159 doesn't, to me, doesn't seem to be expensive, but again, I don't know the market yet. That's why we're here. 159, 149, 145, 135. That smells like a 120 offer. All right, let's see. It really smells like a 120 offer.
Remember, one thing that you did when we started looking at this, we're not looking for resale here today, right? So it might, and this happens all the time, team. There's really fantastic cash flow markets that are great for rental, terrible for equity buildup. They just, they don't appreciate. They're we call them the steady eddies. They're very steady in what you can make. Rent stays either steady or slowly climbs up. Prices don't shoot up, but they also don't fall down really hard. And it's just one of those things that you just collect cash flow, but you're not going to expect big appreciation on the property value. And so it really just depends on your investment strategy.
This is a 4-bedroom home, 1.5 bathrooms. That might be the reason why it's not, too hot, because you're probably missing the shower, obviously. But look at the rental. That's perfect. So let's say you go, you still spend another, 2-3 grand in painting it and doing some landscaping and maybe, changing a couple of things here and there, washing carpets and, done. Let's say you're all in at 140, 145. That's your number right there. I like that one.
That meets your 1% rule. Yes, sir.
So rule, hold on. I'm going to open the notepad because this one goes into my other list. So I might have to take a motorcycle trip to Birmingham. All right. I like that one.
Uh-oh, Kevin, watch out. Lewis is going to be on the road, man.
All right, let's see. Let's have a look.
By the way, Kevin says, thank you. Great info. Thank you, Kevin. We appreciate you being here.
149. You see, too pretty for the price. Completely redone. 4 bedrooms, 2 bathrooms. Does not have the washer and dry, but you don't have
look at the size of that house, man.
You don't have to do anything to move into this one. Let's see. This is probably a flip, if I can say. Let's have a look. Listed for sale. They've been coming down since 159. Let me try to find this history on this one in Realtor to see if I can see something different. Completely done, 4 bedrooms, 2 bathroom home. Property history.
Boom.
Yeah, but this is something different.
They probably bought a package.
They probably bought a package, yeah. They bought a package of properties. All right. So whatever amount, who knows? We don't know. But yeah, the list of 159 has been coming down in price in September to December was the last reduction. Again, now let's run the magic number. If the other house was rented for 1,700 for 1,500, this house has to rent for more. Bigger 2-story garage. Let's have a look.
Terrence asked, what is a package? So a package, when we say a package, it's probably what we're referring to is a portfolio of properties. So say Kevin owns 15 rentals in his market. Eventually, when he's looking to exit, he's probably going to rather sell them as a package, as a rental portfolio instead of one by one. If he wants to do that in a tax-free or in a tax-deferred manner so that he can upgrade and go to a larger property, maybe a commercial property, a multifamily building, he'll go ahead and find investors like Lewis and myself that are willing to pick them all up all at once. And it means one single transaction for him, and it's easy for him to do what's called a 1031 exchange, which we've talked about in the past. And a 1031 exchange allows you to defer the profits on those sales. By doing it as a package, you only do 131 exchange versus doing 15 of them on, one per property, which can get kind of very expensive, and then it might just eliminate the need for it because you won't have any profits. Does that make sense, Terrence? Did that answer your question? Perfect. Thank you.
All right, so gonna need Kevin to explain us the town. I don't understand how a house that nice can rent for that amount. And I just changed it from 4 bedrooms to more than 1 bedroom and give me the same amount. So here,
All right. If you zoom in on the map, I know a little bit about Birmingham because we did do some wholesaling up there. But let's do it on the Google map. It's hard to see.
no, this one's not gonna tell me. So let's go.
Okay, Kevin says this area could be a little dangerous.
So I need to go with my
You know what that means, Lou.
Superman cape. Yeah.
Bring the guns. Okay. Oof, now you zoom
So where should we look up? Where's the looking at town? North, let's say with Birmingham, northeast, northwest, southwest, southeast.
What would you say is the better part of town in Birmingham, Kevin?
Vestavia, Homewood. Okay, and that is northeast, northwest, so I can use it in the map.
Right here, right here.
To find here. I see it. Vestavia, no, I don't see it.
Aquí, mira.
Vestavia Hills here. Yep. Okay, cool. Vestavia Hills, Homewood, from just south of town. Okay.
So you're gonna be a little closer to 65 over there, which
so let's
down here. There we go.
let's see. Let's look at properties.
Right where there's like no listings.
And there's no listing. Yeah, it's property, they're more expensive than 300 grand. But this property was down here, correct? So we shouldn't look into this area too much.
Maybe let's check out these that are on the border. So it's just like outside the areas.
Yeah. Let's have a look.
Which is, it's a very, very valid strategy. You know, you want to stay close to the path of progress, but maybe not dead smack in the middle of it because there might be a little, priced out of the price range.
Bro, I will fire the realtor just because of these pictures.
But you don't want to picture the floor, the AC vent. It's important to see the AC vent on the floor, dude.
I will smack him. There you go.
Look, but the baseboard is installed properly, man.
Oh, and there's a fan.
All right, team. So Lewis does have a thing for listing pictures, Out of the two of us, he's a very creative guy, and one of the things that is a pet peeve of his is these kind of pictures right here. Beautiful flooring, but where am I looking? I'm guessing that's the laundry room. That looks like the laundry room, but so that is very important when you guys are out there working. You don't always have to hire a professional photographer. Just make sure that the pictures make sense, that they excite you. If they don't excite you, they're not going to excite a buyer. They're not going to excite a tenant. And that is especially true for all kind of properties, right? Some people say, oh, but this is a lower end property, or this is just a rental. It doesn't matter. Remember, you have to be visually appealing. This is going to be someone's home.
Bro, he has a light switch.
Wow, look at that baseboard, Justin says. Such a good baseboard.
And just by looking at those little things, I'm sure it's really good job. So this looks
it does. It looks like good construction. It's nice and crisp. Really there's no paint overages.
But ya tú sabes. Let's see if I can find something now. All right. So I like this website Statoly because sometimes it gives me the photos from the previous sale. In this case, it didn't. They bought it for 45 in 2020. They listed in 2022 for 224. So this completely redid everything on this house. Let's play here.
All right, Lou, 5-minute warning. We got Mr. Jeff Miller in the house already, so let's wrap up this in the next couple minutes, and then in about 5 minutes we'll bring Jeff on, and it's gonna be some greatness.
Oh, it's gonna be awesome. Oh, what did I do now? So let's have a look and see if we can find what the hell was going on with this one. Should be the one. This. And it took me to the alley. Man, Google's smarter than me. All right. So I guess this is the correct one.
There we go.
Who
That
knows?
looks like
This one? It's probably this one. I can see a number. I cannot see a number. Oh, well, let's play by ear. So it's a really nice rehab. They're asking for 214. Let's see what Rentometer says. Damn, that's good. You see, 1800. Again, it's not bad. It's not bad. You can, again, this one has been in the market for few
70
months
days.
now.
Not that long.
No, December. It's not bad.
But
Prices.
actually, let's look at that. Go back down real quick. Go back down real quick. Look at this. Listing removed.
Yeah, but
So
there are
something
different
happened
prices.
there.
They probably bought it. They kind of did something. They decided it was not enough.
And then they
probably did more,
rehabbed it some more. Yeah.
and that's-
But that means that you could definitely, try to lowball these guys a little bit and make it come in within the numbers. But most important thing that we wanted to outline here today for you guys today is that if the numbers don't work, you can always submit a lower offer or just walk away.
All right, so that one didn't work. Let's have a look, another quick. So we want to be Homewood, let's see, 150 somewhere over here. Let's have a look. Again, another rehab. I don't like this one. I don't like the layout of the kitchen. But again, you might find a tenant that doesn't care. So not a nice sun, it has this roads and it needs some work. At 149.9. So who knows what the work is? 134 days. Properties, sellers did not live in the property prior to sell. Let's see.
421 they bought it.
They bought it 103. They listed at 103, they bought it for 100. They listed for rent at 1%. Bingo, that's your number right there. Okay, listed for rent again, and they probably couldn't get that money because they have not repaired the house. And they decided to sell it. Listing removed, or they rented themselves, who knows? But no, if it was listed immediately, let me see if the property says anything about showings. Because it might be occupied by a tenant. Ooh, that's not good. I wonder, I know now why the prices are so low. Again, guys, just buy always good school districts and ideally close to hospitals. That's the areas that we like. People will make the effort to pay extra for a nicer home in a good school district. Over here, it's not happening.
Yeah, so that is definitely room for another show. But even if the rental income is fantastic, you want to be cautious of those lower end school systems. I think we wrap it up here, Lou, and we move on to the presentation. So we can bring on Mr. Miller, the man, the myth, the legend.
Let's move it.
All right, team. Thank you so much on that one. If you guys have any questions on Rentometer and rental values and all of that, as always, please reach out to us. Jeff, you should be a co-host, so you should be free to share your show your video. There you go.
Hey guys.
There he is.
Welcome to the show. So glad that you can make it today, Jeff.
I am very honored to be here. I was enjoying your deal discussion just now.
Awesome, right? It does. Not only one of them penciled a little bit, but it's fun to look at. I love doing homework on deals.
That's what we're always doing here at Foundation.
Yes, sir. So it was really good to reconnect with you a little while ago. A little bit of a backdrop. Jeff is with Foundation Cref. I've been working with you guys for, I don't know, several years now. It's a source of deals and lending and a lot of good stuff. And he recently reached out to me. We hadn't connected in a while. Things were a little bit slower for us down here in the South Florida market. As you guys know, as we've been telling you, it's been hard to get deals. So we've been a little bit slower. but we reconnected with Jeff, and it hit me. What a fantastic person to bring on the show, because they have not only a source of deals, but a source of capital. So I don't want to take away your time, Jeff, but go ahead and run with it. Tell us a little bit about yourself and about Foundation.
Sure. This is my second career doing direct private lending with Foundation. I spent 36 years in institutional real estate, primarily doing acquisitions and portfolio management for property funds, core and value-added property funds. I joined Foundation at the beginning of 2021 after my job was eliminated after 10 years with my former fund manager, and started working with a couple of acquaintances of mine, Chris Cravato and John Seeberger, the founders of Foundation, and really enjoyed the work, enjoyed working with investors, and kind of bringing my institutional concepts and skills and thought process, down to the private investor level. So I've been doing this for going on 3 years. The company's been in business. This is our 5th year in business. I think it's an exciting business model with a great tech platform that we use to both sell off-market properties as well as work our bridge and DSCR loan programs from. There you go. That's the main screen. If you log in, Hector, and pull up the property portal, that'd be perfect. Or I can do it if I can figure out how to share my screen. I could do it from this end, but might be better if you're at the controls.
Louis, do you have my my login for that? I don't know if you have it saved already. If not, it's all right. Jeff can take over.
There you go.
There it goes.
Yeah. So, when the company started out, the first year or two, we were primarily a clearinghouse for distressed debt fund managers that raise institutional capital to buy large portfolios of non-performing loans, primarily in the 1 to 4 unit segment, occasionally some smaller multifamily loans. And literally they had a spreadsheet with addresses on it and property information. And they created a network of trustee sale buyers, foreclosure buyers, that they would share, after signing an NDA, share these spreadsheets with. And pretty soon, within a year or so, you see this online platform we call the property portal, and it's both a listing of off-market properties, but it's also our loan platform, our financing platform. So we generate loan apps, term sheets. We have the deal calculator function, which I'd like to just show you. It's a pretty cool function as well. That's all accessed off this property portal. You have to create a free user account to have access to it. There's no charge. It's basically open to everybody, small investors, large investors. We work with everybody. I've done a lot of business with first-time investors, and I've done a lot of business with long-time investors who have portfolios of 100, 150, 250 properties. So once you create your user account, you have access to all the information on these properties. If Hector, if you click on, if you're logged in, if you click on one of the properties, or I can show you from my end, share my screen. So I just show you show you the power of the deal calculators. Here's the deal calculator from an actual bridge fix and flip loan that I've been working on. This is down in Little Rock, Arkansas.
Okay.
I'm based in Connecticut, south of Hartford, but in the past year I've closed loans everywhere. Texas, Montana, closed 3 loans in Montana, Idaho. We operate in 45 of the 50 states, and probably by the end of this year we'll be able to operate in all 50.
Nice. That'll be
So
fun.
this is our deal calculator for fix and flip. So I usually illustrate how important accuracy on the rehab budget and on the as repaired value is. You know, my clients, they always seem to focus on, you know, what are your rates? What are your loan points? When the question is really to them, how well do you know your market? How focused are you on your market? How sure are you in your market that this amount of rehab, 30,000, will equate after completion to this amount of as repaired value, 230,000? I mean, you guys know that's the name of the game.
Yes, sir. You got to
And
make your money
buying,
when you
you
buy.
know, aside from buying right at the right as is value,
Yep.
which is always a challenge.
Yeah.
So, you know, I always love showing them a deal calculator and saying, well, look, you know, you're worried about rate. Yeah. Bridge loan rates are up in the mid 11s now, 11 and a half. All right. 1 year ago, I can tell you exactly 1 year ago, before the Fed's March rate increase, this number would have been 8.5, right? The loan interest rate.
Yep.
Let's just say, okay, let's call it 9.5. Yeah, your profit would be higher, right? I
Yep.
mean, that's a big difference. That's 200 basis points in the rate, let's say. Your profit would be 20,000, return on equity 54%, right? Based on that cash investment of 37,000. But I like to show them this. Let's just put this back to 11.5, right? 18,000. If you miss by a third on your rehab budget, and it's
Ooh,
not 30,000, it's 40,
That's a killer.
right? Right? If it's 40,000, whoa, your profit's down to 8,000.
Yep.
And what if you miss by, say, 10% on your after repairs value, right? So all of a sudden, that's 207, not 230. It's a loss.
Now you're losing money.
So why are we worried about interest rate and loan points? Because that interest is only going to be out 7 months. That capital is going to be out 7 months. We don't charge Dutch interest, so interest is only being calculated off of what you've drawn. So after the initial funding here, right, 120,000, we're waiting. Basically, the borrower is putting maybe the first 10% into the rehab, and we're waiting the first draw request. So construction time, you know, the money is out there for maybe 3 months to do a $30,000 rehab.
Yep.
And that has a relatively lower impact on your returns than missing on the rehab cost and the as repaired value. So, you know, I try and bring kind of the institutional level concepts, modern portfolio theory, diversification, but granted, I work with investors that have small portfolios, but my main message to them is market focus. You know your target market inside and out. Know it block by block, property to property, because these assumptions you make, right, on your budget and how every dollar budget converts into incremental value added, your as repaired value, that's going to make or break your investment.
Yep, absolutely, Jeff. Let me unpack that for a quick second here, just to make sure that some of the newer people on the call are following. So what Jeff is referring to is that after repair value that we always talk about, that, you know, one of those key numbers in your calculations as to how much you can pay for a property. The way we typically like to do it, Jeff, is we start with the after repair value and we start backing out everything else, all our costs, all our budget, you know, and what we want to make, right? Because profit is very important. I don't think there's a lot of people that do fix and flip or fix and rent for a nonprofit. They are in it to make money. So it's very important to focus on your budgets and your after repair value, to know your markets, because like Jeff was saying, the interest rate is going to be out for a short amount of time. What he was alluding to when he was discussing the 120 numbers here, right? The way it's going to work is you're going to get your initial loan, and then you're going to put up the difference of the purchase price and that initial loan. Then you're going to do a little bit of rehab. You're going to ask for an inspection. And then once you do some of that rehab and it's inspected, then Jeff will send you out a check for whatever you've done so far. And then so you don't start to dip into this, into the construction budget until you start to use it. And I don't really see the construction draws here. So my guess is it's a little bit lower.
Right. This is just looking at it, you know, that the construction draws are out for 3 months.
For 3 months, okay.
And, you know, the calculations just use a more typical, you know, construction draw schedule for a
Gotcha.
3-month period. So, you know, the investment hold time is also critical here. I mean, if you can turn this deal around, this flip around in 4 months after 3 months of rehab, watch what happens, right? What was a negative return is reduced. So if you are correct then about your as repaired value, let's put it back to 230,000, right? And let's put the rehab budget that you overran back to 30,000, right? There's your $23,000 profit. So you're going to take 3 months to do a $30,000 renovation. That's comfortable amount of time, you know, for an experienced flipper. That's a lot of time. And you're going to basically sell the property at the end of the 4th month since your initial funding here, your purchase, right? Watch what happens if it takes you 9 months to do all this. All of a sudden your profit dropped from 23,000 down to 15,000. So time, accuracy of your assumptions, and you know, all that comes from your experience in rehab. You're working with a GC, you get the right GC. If you're doing it yourself, you need more experience, and your knowledge of your local target market, which enables you to say, okay, I've looked at comps in the marketplace, and you can use Red Bell to do that, right? So I'm going to shift up here. And watch this. Here we go.
Nice.
Here's the Red Bell comp analysis. So it's saying the valuation here is 132,000. So your as-is value is pretty spot on. What did we say? 100? Well, we said 140 or 150. And again, you can go through the comps and look at each comp. You know, you hover. I'm just hovering over each one, and you read that and say, okay, that's renovated, and try and glean. You know, is this the level, the condition level that I'm planning to bring the property up to? And say, yeah, this is a good comp, right? So you can both test your as repaired, your as is values by using this, as well as look at the more improved comparables and say, okay, this guy already did the work that I'm planning to do on this property. Here's what he sold his property for. So as you scroll down, you see Radian Home Genius gives you also the currently listed comparables. So you see what's on the market right now.
Yep.
Right. And it also shows you what's under contract that's comparable right now. So very powerful tool. And you can, this is for a property in Little Rock, Arkansas that is not on our property portal. So I've got clients who basically use this day to day in their business. They're not even interested in portal properties, buy them from Foundation. They're interested in their own deals that they're pursuing wherever. And they want to run some quick numbers. They want to bring up some quick comps, get a quick valuation take on it. That's the beauty of our property portal.
That's awesome. It's such a robust tool for sure, man. And it's cool that, you know, you guys allow people to use it, not just for the platforms, because again, to kind of reiterate, right? So Jeff, on Foundation's portal, they have properties that they themselves, their partners are selling, right? That they're selling for their partners, but they also do the loans on those properties and other properties. Am I correct, Jeff? Can I just find a random house on the street if you loan on those?
Yeah. You know, in our early years, first couple of years, we were mainly selling properties that these institutional distressed debt funds were asking us to put up on our portal. Then we started doing bridge financing to do fix and flips and fix and hold for rental income. Then maybe in the third year came along DSCR 30-year cash out financing and acquisition financing. And that's where we are today. So, you know, I can from a deal calculator, from this deal calculator, I can click one click of the mouse. I can pre-populate a loan application off of this, and I can pre-populate a term sheet. So once this is fine-tuned. Now, if you go down, I'll scroll down. You haven't even seen. So we've been looking at the purchase cost, loan points, right? Closing costs. Here's the loan terms, right? Here's the closing cost section. So, you know, what I do for clients is teach them how to populate this. We use title fee calculators like First American Titles Calculator.
Yep.
And I show them how you can get an estimate of what your transfer taxes are going to be, what the owner's policy and the lender's title policy are going to cost you. And you can go in and change all of these assumptions, right? This also shows you all of Foundation's fees. Yeah, we saw the points above. The points are over on the left. I think 2 points on this deal. This is our underwriting fee for a single family rental bridge loan, and this is our processing fee, $495. So those are 2 Foundation fees. We have an appraisal team that goes out and gets 3 or 4 bids for appraisals, and these are with appraisal management companies that will come back to us generally in hours and say, we have an appraiser who can do this for you for this price, you know, typically about $650, right? And as you go down, we even provide the client the residual analysis, right? So here's that as repaired value we discussed earlier. You can change your expected sale cost, 6% in this case. So there's $13,800 to sell the property, less the property taxes and insurance you'll pay during that. Well, this is 9 months now.
Yep.
That hold period before the property is resold or refinanced. Here's the property taxes and insurance that'll be payable during that 9-month period. Here's the interest carry calculation for what you're paying on the initial funding. Here's the interest carry on your construction draw from that 30,000 rehab escrow. Here's your net exit price, right? There's your less your cash investment, less the loan payoff of 150, 120 initial funding, 30,000 for the rehab. Here's your profit. So, you know, in a couple minutes, once you get experience using this, you can check the feasibility of your deal and check different loan assumptions. You know, I have clients that use this to finance their deal with another lender. That's fine.
It is what it is, right? You're just there to provide value,
Right.
which is amazing.
I
Which is one of the
mean,
things
you
that I
know-
love about working with you and with Foundation. It's definitely it's not a one-way road.
Yeah, you know, it's we want to provide our clients with all the tools they need to make good investments, and if that means, you know, finding a different lender with better terms, so be it. But we'd like the opportunity to go back, if they do find that lender, and beat that term sheet.
Let me
So-
outbid them.
Right.
I love it. Jeff, so obviously this is extremely valuable and the team can see, you know, how much time they can save. There's spreadsheets and things that we share on how to do this stuff, but it's really cool that you guys have everything built into the site and you can pull the comps and everything. But let's dive in a little bit into the last couple of minutes. We have about 5 more minutes left. Let's dive in a little bit into what the debt market is going to look like for, you know, this is called bridge
Yes.
financing. And if you would go ahead and explain the difference between bridge and hard money, the traditional, you know, what everybody hears as hard money. And let's give the team a little bit of an outlook as
Well,
to
you
how
know,
things are
I
gonna
think,
be.
I mean, you have a lot of experience, Hector, with hard money lenders. It's primarily an asset-based determination, right? And there's very little due diligence and underwriting done on the borrower and the borrower's credit, borrower's experience. We're bridge loan lenders, not hard money lenders, because credit of the borrower is very important. Their experience, their liquidity. We verify liquidity. We have a liquidity test beyond just the cash required for equity and closing costs to get a deal closed. And we have an underwriting team that does this, that works with me when I originate a new opportunity that does it. We have a closing team that takes a fully underwritten deal into documentation and through closing. You know, in any typical bridge loan deal, we have 7, even more people on our team working on it. Bridge loan lending has changed dramatically in the past year. No surprise, Federal Reserve about 1 year ago started increasing interest rates. We're at a point now where in the debt market, we have an inverted yield curve. So short-term rates are much, much higher than long-term rates. And that's severely impacted the bridge loan financing market. This loan that I outlined for you 1 year ago, I know this borrower very well. I know his credit. This would have been 8.5, not an 11.5 rate, right? And might have even been 1.5 points for this particular borrower. We're now really at the 11 to 12% range, again, depending on FICO score, experience. You know, we want to see bridge loan fix and flippers with at least 3 completed deals under their belts, preferably more, to get the best rate and execution in our program. However, we work with people who have not ever completed a flip. The difference is we back off the loan to value to give them a little more room, a little cushion. We increase the rate a bit more as a risk premium. They might pay 2.5 points on a deal like this, not 2. but pretty soon they've got 3 deals under their belts and they're getting much better pricing in our program. So also credit. We used to do bridge loan financing for FICOs down to 620. That's tightened up. It's now 650 or 660, depending on experience. Where it's going this year, I wish I knew.
Where's your crystal ball, man? Come on, get out of the drawer.
I'm not going to begin to tell you I've got any insights into predicting interest rates, but certainly today's jobs report with 311,000 jobs, like a third more than was expected, and unemployment only notched up to like 3.4 to 3.6% rate. We think Chairman Powell, our house view is that Chairman Powell and the Fed are going to continue to be hardliners on rate increases. And next week, we expect 50 basis points and maybe another couple 50 basis points increases.
So you're on the 0.5 point camp. Okay, it's good to know.
Yeah. I mean, every indication is that, where inflation is today is 6.5. They'll have to continue increasing rates to get anywhere near their 2 to 3% target inflation. So let's talk about DSCR in the last few minutes. DSCR is tightened too. What we do
First, can you first define
is,
DSCR for some of the viewers that are not familiar?
Yes, thank you. There's a lot of jargon in this business and acronyms. Debt service coverage ratio. It has become the most important metric in long-term financing. It simply the net operating income divided by the principal, interest, taxes, and insurance payment, and monthly. And we used to do a lot of lending at DSCRs of 1.00 and even less. Now, pretty much to get good rate and terms, you need to be up around 1.15. And a lot of my, more experienced clients tell me solve for 1.25.
Yes.
Because they think if a recession hits, if their rental market changes and rents drop, or people start losing their jobs as the Fed tries to control inflation, they want more of a cushion. So essentially, a 1.25 debt service coverage ratio means you've got 25% more in free and clear net cash flow after you make your monthly payment for principal, interest, taxes, and insurance, and association fees, if that's applicable.
Yep.
So people are saying, I'm battening down the hatches. It might be rough times ahead, maybe not so rough, but I want to be sure. So
let's put that into numbers real quick, Jeff. So what he's saying is, if your mortgage payment is $1,000, the minimum that you should be bringing in for them to even look at it is $1,150, but you really should be at $1,250.
exactly.
For the sake of your own cushion. And we always advocate more cash flow than that, actually. But yes, that's like bare bones, like risking it. You're living on the edge. Have 25% cushion.
So in terms of rate, it's really DSCR that drives loan to value and interest rate, not the other way around. People call me and say, oh, can I get 75, 80% loan to value? Well, then when we lay out the numbers, they're barely getting to a 1.00 debt service coverage ratio. So the answer is no. I mean, unless you want to be using your other property's cash flow to feed this property that's in a deficit every month after you make your payment. So to sum up, we can use DSCR 30-year term financing for both acquisition of single properties and entire portfolios. We can also use it for cash out refinancing of single properties or entire portfolios. And Hector, as you know, 30-year fixed rate financing is very expensive right now. You're up in the 9s pretty quickly. So what we're doing for our clients is structuring what I call the low-cost long-term bridge loan. It's not a bridge loan, because a 2-year, 3-year bridge loan is you're gonna be paying 11.5% or more interest only. It's actually a DSCR loan where we've structured it as a 5-year adjustable rate mortgage, a 5-year ARM that starts adjusting annually in year 6, with only a 3-year prepayment penalty period. And we also offer the option, if the debt service coverage ratio is adequate, the option of a 10-year interest only period to start a 30-year term. So interest only for 10 years, then the last 20 years of the term, you're fully amortizing the principal balance. So obviously, if you think about these terms, this is a long-term loan that's designed to be refinanced once rates come back down, somewhere between the end of year 3 and the end of year 10. But it offers the borrower the option, if, in year 3 of the loan, you're seeing rates starting to come down, and by the end of that year, rates are more favorable than your fixed rate that you have through the end of year 5, you can refinance with us or any other long-term lender at a better rate without penalty. Because I don't see the point of locking people into long-term loans that have 5 or 7 year prepayment penalty periods at this point.
I love it, man. I love the flexibility that you guys are out there looking to serve the client and be flexible. Thank you so much for all the information you've shared today, Jeff. It's been wonderful. Getting a look at the portal, listening to your your outlook on the debt market is definitely always interesting. I love having these conversations with people like you that are way more informed. They're way smarter than me, because I always catch something. Team, if you have any questions for Jeff as we wrap up, please throw them in the chat. Jeff, any last minute thoughts as we close out the segment? My view is, in hard times, in a market transition like the one we're in, with continued rising interest rates and possible, the Case-Shiller Home Price Index now is 6 straight months of value declines. Probably going to continue. It's hard to say how much, but my view is back off on loan to value, back off on leverage. Know your market fundamentals as well as anybody in the market. A very, very famous property investor named Trammell Crow said years ago, there is nothing but the market. And he also said something that always stuck with me when I was my years doing commercial property acquisitions. In every market, there is a fool. If you don't know who the fool is in your market, it may be you. I love that. I've heard in every room there's a fool, so that's good. That is awesome, Jeff. That's very well said. We too have been advocating for those lower LTVs, loan to values, for a while now. I'm somewhere in the 60 to 65 range these days. It's better to be conservative. If you can get even lower, lower than 60, you stand to lose less if the situation goes completely sideways.
Yeah, everyone should give themselves breathing room this year.
Awesome. Thank you, Jeff. We appreciate it, team.
Thanks, guys. Thanks,
Jeff's
everybody listening. Thank you.
Jeff's contact is here on the screen. Whether you're watching on YouTube or you're live here today, please take a screenshot. Reach out to him with any questions. He's a very easy to talk to person. Is super knowledgeable, as you can see. So reach out to him, email him, call him. He's always readily available and always has insight into many different markets and many things. He sees things from a huge lens, way big lens. Like he said, he's got that institutional background and can dumb it down to right to our level as well. As always, thank you all for joining us, for being here, part of the show. If you're watching on YouTube, please make sure you to like and subscribe. It makes us feel warm and fuzzy when we get those thumbs up. Lou, what you got? Close her out.
That's it. So I hope you like it. Thank you, Jeff. That was a lot of really, really good information. I love the website. I love the setting because we have spreadsheets here, there, and everywhere, and you have everything condensed in one place. Very easy using. So I'm gonna be looking into those. Thank you so much, Jeff. Thank you so much, everybody.
Thanks, everyone. I appreciate your time this afternoon.
Oh, I appreciate you being here. And
Bye-bye now.
any questions, any comments? We are always around. We're always behind the screen. Real estate at reallifetrading.com. If not, you can find us at reallifetrading.com/RE. You're gonna have all the information about real estate. See, it's here. You can find our information, where we at, Mr. Boy here, me here. We have mentorship already. We're gonna bringing you the Burr mentorship coming soon. We still don't have a date for that one yet, but Brian's gonna show everybody how to make, you know what, $5 million, $6 million portfolio now that he has in 5 years. So that's my boy. We have pencil mentorings. If anything else that you might want to know, all our previous sessions are here. So again, find us at reallifetrading.com/RE. The usual, like and subscribe. We get all fussy. We all get all happy if we get comments, if we get emails. Please let us know any questions or any topics that you want us to take. And with this, let's close it. Thank you, everybody. Happy
Thanks,
Friday.
everyone.